Residential property prices have seen a modest increase of just 1% over the past year, a notable improvement from a decline of 0.9% the previous year. This slow growth is largely due to an abundance of homes for sale and ongoing affordability pressures, which continue to limit buying power. Despite these challenges, the overall value of residential properties in the sales pipeline has reached a 4-year high, rising 30% year-on-year to £110 billion. Encouragingly, first-time buyers are expected to become the largest buyer group, making up 35% of sales in 2024. Throughout the year, there has been a positive transformation in the market, reflected in a resilient trend of house price growth. Both affordability and overall confidence in the sector have improved, suggesting a more optimistic outlook as we head into the new year. This month's modest price growth reflects a significant increase in buyer options, the highest since 2014. With buyers in a strong position and a wide selection available, sellers must price their properties competitively to attract interest, especially given ongoing affordability challenges. Some sellers seem to be adjusting their expectations, which is contributing to limited price increases and better affordability for buyers. As a result, the number of sales being agreed is notably higher compared to the quieter market of last year. While overall activity remains steady, some estate agents report that certain buyers are postponing their decisions, waiting for clarity from the upcoming budget and hoping for lower mortgage rates later in the year. Nevertheless, many movers appear to be proceeding with their plans regardless. Given the UK government's ambitious goal to drive growth after a turbulent period, there's hope that this week's autumn budget will serve as a catalyst for improving housing supply. Property Mark has consistently advocated for stamp duty reform, particularly to support those looking to downsize. This change could encourage more movement in the housing market, helping to alleviate some of the supply issues and enhance overall market activity. By making it easier for individuals to make these transitions, we could see a more dynamic property landscape. I hope to see further progression on potentially cutting interest rates, as this will continue to improve the overall health of the economy. The housing market is experiencing significant variation across districts and price bands. In some areas volume has grown by over 50%, but on average year-on-year growth has reached approximately 30%, largely driven by lower interest rates, which have spurred a resurgence of first-time buyers. Furthermore, many sellers, who had transitioned to rental accommodation during the period of higher interest rates, are now re-entering the market, often mortgage-free or with substantial deposits. Buy-to-let activity has notably declined as smaller or accidental landlords exit the market, influenced by less favorable financial conditions and increasing regulation. Consequently, much of the new housing stock now comprises former rental properties. Additionally, transaction completions have risen in the last couple of months, particularly within the investment property sector, as sellers seek to conclude deals ahead of potential changes anticipated in the upcoming budget. The latest snapshot of sales activity shows that the number of sales being agreed is now 29% ahead of the same period last year. Therefore, sales activity has not only bounced back from the low of last year but has continued an upward trajectory. There is also a healthy level of underlying buyer demand as people continue to plan their next move. The number of people contacting agents about homes for sale is up by 17% compared with this time last year. With mortgage rates having fallen in recent months and more bank rate cuts likely to come, we believe that property transactions will continue to rise in the near term. Given that there are plenty of motivated sellers ready to list, I sense that the market will enjoy a strong start to 2025, as stock continues to grow and mortgage rates potentially ease further. The property market has been extremely active this year, and we currently have 17% more properties under offer than in 2020. Pent-up demand, improved mortgage deals and people's desire to find a property ahead of the autumn budget have been key motivators for house hunters to finalize their search. The number of sales being agreed is up by 29% year-on-year, a strong rebound from the weaker market a year ago. However, despite this strong housing market activity, the number of new properties coming to the market, and the time they are taking to sell are both increasing, resulting in an increase in available homes for sale. This reflects that some aspiring buyers are still priced out of the market. The number of available homes for sale is 12% higher than at this time last year, but also the average number of homes for sale per estate agent branch is at its highest since 2014. Competition for buyers is particularly intense at the top end of the market, where the number of 4-bedroom detached houses and 5-bedroom plus homes available for sale is 17% ahead of last year. It's a buyer's market, reinforcing the need for sellers to price competitively while affordability is stretched and choice is high. After a long run of mortgage rate drops helped by the August bank rate cut, rate falls are stalling for the moment against a backdrop of geopolitical tension. The average 5-year activity has been strong. I've seen a surge of new instructions in September and is one of our busiest months for new sellers in the last decade. We've also seen a good jump in new potential buyers, as well as agreed sales in the area, so it's been busy. The bank rate cut and lower mortgage rates definitely played their part in helping more people to come to market. There's always some uncertainty surrounding the budget, but we're not seeing any buyer hesitation due to it. Despite some mortgage interest rates trickling upwards, the changes are small and not of major concern right now. It's great to hear that this has been one of your best years for transactions in 18 years. While the level of activity has been impressive, it's clear that muted price growth may be influenced by the new normal of higher interest rates and the sharp increase in values seen post-pandemic, which will take time to stabilize. As we approach the new year, a pre-election pause was anticipated, but the expected delay due to the new government's first budget adds another layer of uncertainty. Nonetheless, there's hope for a strong finish to the year once this pause is lifted, as the market could regain momentum. Mortgage approval levels have been strengthening for much of this year, and we're now seeing this increase in buyer demand start to filter through to actual sales, with monthly transactions being the strongest since 2022. This improving market momentum has also helped to tempt many sellers back into the market who had previously put their plans to move on pause. Of course, there will always be a segment of both buyers and sellers who will sit tight in the hopes of some form of property market boost via the upcoming autumn budget. However, we're not seeing this at ground level so much, largely due to the fact that very little has been leaked with regard to the sales sector. The big picture still looks positive for the market heading into the coming year. Market activity remains strong, despite affordability pressures on movers. Affordability is still the biggest barrier facing many movers, with mortgage rates still high, so if the expected 2 cuts come to fruition, it could be the boost that many buyers in waiting need. Despite ongoing affordability challenges, there are encouraging signs for 2025. Financial markets are forecasting 2 bank rate cuts by the end of the year, which could lead to further reductions in mortgage rates. While these rates may not drop to the ultra-low levels seen in recent years, any decreases, combined with rising wages and modest house price growth, could significantly improve affordability for home buyers. This shift might pave the way for previously priced out buyers to re-enter the market in 2025, fostering a more inclusive housing landscape.